Morning, everybody. Let's continue. Now, let's continue with the chapter savings. Now, we'll start with emergency funds. What do you mean by emergency funds? Money set aside for unforeseen costs is known as emergency funds. Means that any fund which is kept aside for unexpected expenses or cost means that you don't know that expense can occur anytime during your life or during any time. So you cannot go to the bank and collect money. So what you need to keep this fund aside for emergency fund. This assists with the paying for unexpected job loss, like suppose any person who just due to recession or due to inflation, or like during the period when the company is laying off the employees, there might be unexpected job loss or any repairs occurred, any medical emergency has incurred. So you need money, so you can't go to the bank and easily and remove money. Sometimes unexpected events may occur, so for that you need to have emergency funds aside and available with you. It is crucial to maintain an emergency savings fund apart from your regular savings. Means that you have to save. You have regular saving, but emergency fund should never be a part of your savings. It should be kept only for emergencies. Okay. Then, if you want to keep it accessible in case of emergency, just think about keeping it in a different saving account. This stops us you from using funds for things that other than emergencies. Then you have is interest and rates and savings. Means that okay, you are saving everything, but what are you what return are you getting from these savings? What return are you getting from these savings? You get interest rates and savings. Means that the bank gives you interest on such savings. So this is basically a motivation for us that we earn some income. Banks pay you interest rates in exchange for storing your savings with them. Okay. Suppose I can give an example that if you have saving interest, suppose if you want your money to grow with a saving interest, such as say you have 50,000 rupees, you want to save that. You will save at the rate of 4%, and so therefore you will receive how much? 2,000 rupees annually. So this is 2,000 is what? Your income, your extra cash which you would have been received if you would have saved. But if you would not have saved, then how would you receive on 2,000 rupees? So this is what? Your interest income. This is what your interest income you have to earn. This is what a motivation that yes, you please save. You do savings so that we give you income on it. It is crucial. It is critical to comprehend how interest rates impact the savings. A higher interest rate corresponds to faster growth, and a lower interest will lead to slower growth. It means that if you save, suppose in FD, we just learned earlier what is FD and everything. Suppose you want to save in FD, you know that you earn a higher rate of interest in FD as compared to other savings account. So what happens in that when you earn higher rate of interest annually, your have a faster growth as compared to those savings where you have lower rate of interest, you have a slow growth. So this is what again this all it motivates us that yes, we have to keep savings and gives us interest on it. You earn interest on it. Then you make smart choice financial you're making smart financial choices. Again, when you want to have a good financial portfolio or wealth, you should have you should be financially literate. So that once you're financially literate, what happens? It is essential to make wise financial decisions. It is essential to make wise financial decisions for your overall well-being. Making educated decisions can help avoid that. Means when you make any decision, suppose you know things, where to invest, where not to invest, where to increase your savings. There is, where you find more risky. It is risk to make to invest. So depending upon that, you can say a mature decision, which would help you to avoid, any risk. Information gathering is crucial before making an investment financial decision. That so okay, you want to make a decision, but for that you have to make research on it. Once you make any research, then only you'll decide whether you want to invest or not, whether you want to make any smart financial choices or not, depending upon your goal, your objectives, and the income or returns you're earning on it. Always make sure your decisions are in line with financial objectives. This will assist you in avoiding pointless purchases and make a wiser decisions down the road. Okay. Then you have is where to learn more about savings. Where can you learn more about savings, about knowledge, where you can get knowledge on savings? See, you have resources such as books, websites, online courses offer valuable information to enhance one's financial literacy. Okay. Then books about personal finances provides comprehensive details on ways to save money. Then there's a well-known book, that is Your Money or Your Life and the Richest Man Babylon. This is again a well-known book on savings, on how to save money. Again, excellent method to increase your knowledge is through online workshop and courses. You have to attend courses, attend workshops, and just you get various knowledge on it. Then you have platforms such as Coursera, Udemy, Khan Academy offer free courses on personal finance and savings. Okay, this is where you get your knowledge on savings. Then you have is automatic savings. Maintaining discipline can be facilitated by automating your savings. Do you know anything about automatic saving transfers? Means a percentage of your income can be automatically deposited into a savings account. With automation, saving you the trouble. And means what? Now I can tell you what doing automation saving. What you do? See, you're busy. You know everyone is busy in their life, but also you need to save money. What you do once when you open an account, what you do? You give a instructions that you please every month or every week, whatever your on your will, automatically transfer money to the savings account. So what will happen? A percentage of your income can be automatically deposited in the savings account with automations, which you just get a reminder that this much of amount, suppose X amount is being transferred from this account to that account. You are hassle free, you are not in trouble. So this automatically gives you a savings way to save. It's again our automatic savings. Your saving objectives are prioritized when they set up an automatic transfer. You can set up a transfer of 5,000 from your salary account to your savings account. For example, I'm saying. So this is what an automatic savings. Then you have impact of inflation on savings. What is the impact of inflation on your savings? So okay, you're saving, you started saving. Now there's also inflation on savings. What is inflation? Inflation means that the rate on which your purchasing power increases or decreases. Means the rate of expenses increases or decreases. Over time, inflation lowers your money's purchasing power. Means that as inflation increases, your purchasing power decreases. Have you ever noticed the cost of goods rising annually? See, nowadays everything has become very expensive. Purchasing your fast-moving goods also becomes very much expensive. So after this expenses also you have to save. But this also impacts your savings. Your savings amount might have decreased. Like first, initially, so suppose you used to save 5,000 rupees per month, but now Due to increase in inflation, your savings might have reduced to 4,000 or 3,500, whatever. This has impacted your savings. Annually, this will also have impact on your returns also. So it all depends upon, and also impacts on inflation. See, for example, Rakesh saved 550,000 for 2 years, but with an inflation rate of 6% and a bank interest rate of 4%, his saving lost value and he could buy less than what he expected. Means that the bank rate is giving 4%, but the inflation rate has increased of 6%. So the 2% has been lost. So this is what again, this has impacted your savings. Okay. What you can do, you can invest in securities that are protected against inflation or hunt for saving option for higher rate of interest to fend off it. Means that you can invest in securities where you are protected against inflation, and even invest in those options where you get higher rate of interest to defeat inflation. Then you have a savings versus investing. Savings versus investing means investing and savings are both significant. Nowadays, investing and savings are both significant. Have you ever wondered what makes investing different from savings? See, investing and saving is different. It's similar but not same. Investing means focusing on long-term money growth. See, you don't invest for short term, you invest for long term. Whereas savings are for short term, like for 1 year, 6 months. But whereas investing is for 5 years, 6 years, 10 years, etc. Savings is setting aside for unexpected or short term needs. Whereas for investing, it is not. Investing is for long term and it is not for unexpected needs. Although they have a lower returns, savings are secure. Okay, gives you lower rate of interest, but they are secure. Whereas investments like bonds, mutual funds, and stocks, on the other hand, have a high potential risk, but they reward also highly potential. Okay, this is what difference between a savings and investing is. Again, this is short-term goals, and it is savings is for emergency, whereas investing is for long-term goal. Risk is lower, whereas risk in this investing is higher. You have low returns on savings, but you have high returns on investing. This is for short term, that is for 5 years, but this is for long term, it is more than 5 years. Goal for savings gives you high financial stability and safety, whereas this helps to create a wealth and capital appreciation. In savings, you can lose purchasing power due to inflation, whereas this outpaces your inflations. Okay, this is what the difference between savings and investing is. Then you have savings for retirement. Nowadays, you also have to even save. See, once you're working, you're earning, you have a regular income. You are saving. But till when will you have your regular income? Once in a while in a life, you will always obviously retire. After retirement, what will happen? After retirement, your income will stop. But yet you need money to live, to fulfill your needs, to eat. Then what? This is what you have to save today for your future, for tomorrow. Basically, you have to save for retirement purposes. Like you have PPF, you have EPF, etc. Then again, emergency savings funds. I have again earlier told you what is emergency saving funds. Then savings for major purchases. Major purchases means if you want to purchase a house, you want to purchase a car, you want to pay a big expenses without taking a debt, means without taking a loan. Then what you do? You have to save from purchasing all these items. Then how savings affects your credit. You can raise your credit score by savings. Have you ever considered the potential impact of your saving on a credit score? Despite being distinct concepts in personal finance, credit and savings are closely related. See, do you believe that having a saving will improve your credit? Yes, it will. You run a risk of getting caught in a never-ending debt cycle if you use credit excessively without saving enough money. Means that once you take debt again and again, again and again, this never ending. You get caught. There's a risk of getting caught. Then your credit score will decrease, and once it will decrease without any saving money. Then saving with a purpose. You need to save for a purpose. What is a purpose? You want to purchase a laptop, you want to purchase a house, once you want to purchase electronic, whatever. For that you need to save. It can be for a short-term goal, but saving for retirement can be as a long-term goal. It depends for what purpose are you saving. Saving for purpose is again a most important part of saving. Now, common mistakes in saving. Some nowadays people do mistakes in saving which have an adverse effect on their wealth, on their income. See, they make a lot of saving like consistent, like what common mistake they can make? Not saving consistently or taking out savings prematurely means that they save today, they will not save tomorrow, they will not save day after tomorrow, they will save after. There is a gap between savings. So this will not again help you in your purpose. This will, or sometimes you save, but you take out it prematurely without before maturity. So then again, what? This will again gives you penalty. They will charge penalties, and again you have a not increasing your wealth. You use savings for non-emergency cost. You use your saving when it is not required. Again, it's another common mistake because you should use savings only when it is an emergency and not non-emergency. When savings, some people also forget to factor in inflation. So when you start saving, you should also keep inflation in mind while savings. Okay. Interest rates and other strategies for shielding your savings from inflation should also be taken into account. I hope you understood about savings, what mistakes you make, why you need to do savings, what type of savings you need to keep for emergency funds, or for your purposes, for your short term, long term goal, medium term goal, etc. I hope you liked this lecture. If you have any queries, please comment on it. Please like, share, and subscribe. Thank you.